Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.
Risk aversion is just the opposite. Money comes back to the center, out of these risk appetite classes, risky asset classes, into U.S. Treasuries. The perfect example, the perfect storm was the credit crunch. People came back into the U.S. dollar, not because they liked the dollar, but they wanted to hide in the U.S. capital markets in the Treasuries, and it was that simple. That was a major risk aversion. We're seeing that a bit today. Stock market off a bunch, concern about Greece out there, concern about China possibly not keeping the credit spigots wide open. So what's happening? Risk aversion. The major risk currencies, Australian dollar, commodity currencies in general getting hit very hard. The euro is getting hit very hard on risk. And what currency is doing very, very well? The world reserve currency, the U.S. dollar. We saw these setups starting to set up before it happened, and we positioned our clients for this move. And I'm actually going to use that today, the example of real charts that we sent to our clients ahead of time, kind of looking at this setup that actually worked. I, of course, wouldn't be showing you these charts if it didn't work, but since it did, we're going to use that as an example today. I'm sure Steve is laughing at that one.
No, Jack, you've been calling this for a while, and you've been right on over the last 8 weeks, so I'm really happy. Let's see what happens in the next couple months.
Right, the broken clock, but we're happy.
And
right
no.
No,
you had some real good reasons why this might occur, and now it's playing out, so that's great.
The third point here is you can use these things really to identify really some currency-specific thing, and forgetting what happened in China today, about the news out of China, one of the things we've been following very, very closely is this problem in Greece, and we'll show you some of the chart setups and the intermarket relationships that made sense to us. And also the major macro trends. We use kind of the interest rates and the economic data correlations to really help us drive a major macro trend. And when we say that, we're looking at some things that are out to a year, multi-year basis is what we're kind of thinking of when we use some of this data. So we use a lot of it really in short-term time frames to support our technical analysis, and we use some of it in major, very long-term time frames because we trade in the different time frames, or at least give recommendations in the various time frames for our clients. Very short-term, intermediate-term position trading, days to weeks. Then we have a service, very low leverage ETF service where we'll hold stuff for many, many months, and we use a lot of the yield data and economic data to help make those decisions against the various currency pairs. Hopefully, some of this will make sense when we get to some of the charts. Put a little nuance to it and just some reality to it. We could talk all day on this stuff, and we could create all kinds of charts on this stuff, but just want to try and develop here for you in these seminars. It's just a thought process at first, and then see how this thought process is applied. I talked about this idea of currencies. When you think of all these currencies in the world, how do you choose one? There's just tons of them. Well, you really can you really can break these currencies into baskets. And when we started doing this analysis several years ago, I guess, I think it helped our performance, because when you start to break the currencies into these three baskets, there may be more, but these are three that we use. Then you can start to once this correlation makes sense for the savings currencies or whatever, you're basically, again, increases your probability of choosing the right currency. If there's a lot of risk appetite in the world, the commodity currencies, or the commodity dollars as they're called, are going to do pretty well because they move on growth, they move on risk, they move on excitement, those types of things. So that's the class you want to throw a dart into, one of those currencies, again, increasing your probabilities of success. The trading currencies of the world, that basket refers to those currencies in the world that really, their lifeblood, their economic growth depends on exports and trade and global trade. Japanese yen, and Japanese yen really is its own animal in this environment at the moment, but the Asian bloc currencies would fall into that category, and some of the other emerging market currencies, Singapore dollar, South Korean won, Taiwan dollar, just that whole area, the Malaysian ringgit, all those that are depend more on global trade. Obviously, the Chinese yuan, the Chinese is highly dependent on global trade. Unfortunately, their currency is not. We're not able to play that. This is the point I made earlier. I think I've already made this point of yield. In an environment in which you have very high differential in yield, and let me grab our pen here. If you have very high differential in yield between currencies, you tend to get these giant liquidity moves, sloshing back and forth, and we saw that a bit, before the credit crunch. We had some very low low yielding currencies and very high yielding currencies, and since the credit crunch, a lot of the central banks, as I said, have normalized together and more changed the game in that area, and we think that will change the correlation because the liquidity flows will be quite different when everybody's interest rates are bunched more together. You don't have that simple choice. But same token, yield differentials always matter and still matter at the margin and are very important. We're not trying to neutralize that, but we're saying that the background correlations of, oil goes up, therefore the dollar must go down, changes when you have the various central banks' interest rates that have converged together. The outliers still at the moment, although their interest rates are not very high compared to what they were, there's the Australian dollar. I think they're around 3.5% in that range. Obviously, there's still of the major currencies, it's the big yield dog on the street and has been. But again, that's come down, and we'll see what happens going forward based on what's going to happen in China. Obviously, those currencies with a very, very low yield have been the carry or funding currency. The Japanese yen has been the carry trade currency. For those of you that haven't heard this term, or funding currency, it just means that if it's a major currency and you can borrow it fairly readily, the Japanese yen, Bank of Japan is one of the major central banks in the world, borrowing that currency at 0.5% and using it to fund your other risky asset investments, converted it into another currency automatically, whether it's another high-yielding currency or another investment class that you want to go up. That's the definition. You're using that currency to fund other asset purchases. The U.S. dollar, for a while towards the end of the year, actually took over that mantle from the Japanese yen because the front end of the curve in the U.S. was actually lower than the Japanese yen in the 3- and 6-month range. Hard to believe that the U.S. pushed rates down that far, but they basically did. The Fed is still in that zero interest rate policy. We think that's going to change, and the mantle of the carry trade is definitely going to go back to the yen, and I think that's already started happening to a degree. But that's an important driver always in the currency world, this whole idea of carry. And, and that's seen, straightforward through the yields. Okay, what are we trying to do? We're just trying to identify the correlations using technical analysis or statistical analysis. What does that mean? Well, this part means that you simply have overlay charts, and that's the way we use it. Occasionally, we'll actually do the statistical analysis, which is not very tough. Statistical analysis just means, from our standpoint, is just taking the closing prices whatever time frame you want for that bar, and comparing it to the closing prices of the asset you're looking at, putting that into an Excel spreadsheet and just hitting correlation, and it'll give it to you. And that's helpful. You can do that if you're a numbers guy, but I don't think you need to. Currency trading, this is getting in the right ballpark to make sense. And so from our standpoint, we do it down and dirty and make it fast, and we can look at a lot of charts this way, just looking at the overlays, and you'll see that on as the charts come, just comparing one visually to the other. So you can do it either way, so either way it works, or you can do it both ways, as I said, if you're very numerical and very, very focused.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.